Hello and welcome to the 8th episode in the series on how to build a mutual fund portfolio. In the last episode, we saw the effect of taxation on short-term capital gains from debt mutual funds. Taking on from there, this episode we'll look at their effect on long-term capital gains from debt mutual funds. This will be particularly attractive to fixed deposit customers as well, as it provides a viable alternative with tax gains. Let's get to it then. Let's first understand the income and taxation on fixed deposits. This will help us to understand the effects of taxation from long-term capital gains on debt funds and make it easy for us to compare. So the tax which is levied on the fixed deposits is as per the income slab. This means that interest is added back to the income and taxed as per the income slab. So let's take an example. If the annual income of the person is 10 lakhs, and 1 lakh is earned from the interest on fixed deposit, then the annual income is considered as 10 plus 1, that is 11 lakhs. Also, we have to remember here that there is TDS, which is tax deducted at source. Deduction is made every year when the interest is earned. So if you book an FD for 4 years and it fetches an interest of say 45,000 rupees per annum, instead of giving the principal plus interest at the end of 4 years minus the tax deducted at source, every year 4,500 rupees, that is 10% TDS, will be deducted. So without getting the money in hand, the tax is still deducted. Now the taxation on debt mutual funds for long-term capital gains is done after 3 years. That is, if you invest in a debt fund and you redeem it after 36 months or 3 years, then whatever gain you make is classified as long-term capital gains. And capital gain, as we know, is nothing but the profit or loss one gets when selling an asset or investment. What is the applicable tax? It is 20% with indexation benefit. That is, whether you earned any income, whatever income slab you are at, or if you didn't earn any income also, on the gain that you make, 20% is charged, but there is an indexation benefit. Now, is this beneficial or not? We'll see that. But the application of this taxation is that it is calculated separately. So it is not added back to the income slab and then calculated like the FD. It is calculated separately and then added to the total tax liability. Is there a TDS element? No. You get the full capital gain in your hand when you redeem it. However, when you are filing your returns, then you have to give a capital gain statement and calculate your tax liability accordingly. Let us understand what indexation benefit is. Now, first of all, indexation is used to adjust the purchase price of an investment to reflect the effect of inflation. Inflation is nothing but the increase of prices every year. Now, what happens when this indexation is used to adjust the purchase price of our investment? This helps in bringing down the tax liability for long-term investments like property, gold, and debt funds also. Where do you find out this table and how to calculate this? It comes from the income tax department. So they release the cost inflation index with which we can calculate this inflation effect. So it will look something like this. They'll have the financial years listed on one side and they'll have a number specific to that in the index for each financial year. Now let's understand how this affects our debt fund. So first we will understand what would be the tax liability without indexation. So if your purchase amount in the year 2015 was 2 lakhs, that is you invested 2 lakh rupees and you took it out in the year 2018-19 and the value then was 2,45,000 rupees. And let's say indexation benefit was not there. Therefore, your capital gain would have been 2,45,000 redemption price minus purchase price 2 lakhs, which is 45,000, right? The tax would be charged at 20%, so you would have to pay 9,000 rupees tax and the final gain would have been 36,000. But with the indexation benefit, then even though your purchase amount is 2 lakhs, your redemption amount is 2,45,000, but for the purpose of taxation, the government allows you to inflate your cost of purchase or increase the cost of purchase. So here 2 lakhs is multiplied into the year which you redeem, the index number 280 divided by 254. So now your purchase amount is as though it was 2,20,000 472 rupees. This immediately impacts your capital gain for tax purpose, not your real gain, but your tax related capital gain. It comes down to 24,528, and therefore the tax that you have to pay is only 4,900, and you can see that the gain goes up from 36,000 to 40,000, right? So this is a major benefit of the of indexation, and it is applicable for your debt funds. Compare the income received in 3 years from a fixed deposit to the debt fund to understand the impact of indexation. Now, in the fixed deposit, taking the earlier example, I invested 2 lakhs in the financial year 2015-16. My return rate was 7%. The amount I redeemed was 2,45,000 rupees in the year 2018-19. So the income I earned was 45,000 rupees, and that is to be taxed. Now that interest income is added back to my overall income, and assuming that I'm at the highest bracket, that means I would be charged 30%. I will have to pay 13,500 rupees towards tax. If I compare this with the debt fund, assuming the same figures of investment and rate of return, then my gain would be 45,000 again. But for tax purposes, as we saw earlier, I have an inflation adjustment. So my cost of acquisition goes up. It becomes 2,20,000. The amount to be taxed goes down. That is 24,528. Tax is applied at 20%. So it becomes 4,906. And my returns after tax is 40,000, which is significantly higher than what I could have earned from the fixed deposit. It was almost 8,500 to 9,000 rupees higher. Now what happens if you're at lower brackets? Let's look at that also. So in the same example, if you're taxed at the lowest bracket, then on your gain of 45,000 rupees, 10% is applied, therefore 4,500, and your return after tax is 40,500. In the debt fund, the tax is still 20% because income bracket doesn't come into play here. So you'll pay a tax of 4,900. But because the indexation benefit is so powerful, even though you're taxed at a higher rate, but the return after tax is comparable. So I hope you got an understanding on how the taxation on long-term capital gains from debt funds works and how the indexation benefit is powerful. While the comfort of fixed deposits is there, that it gives us fixed returns, but one factor which I have not considered here is that normally debt funds return slightly higher than fixed deposits. Returns are not fixed, but this is the general trend. So that also increases your return from debt funds. So if you have any queries, please do leave a comment or reach out to me at the contact points which are provided at the end of the video. Thanks for watching.